Welcome to The Explainer. I am so thrilled to have you here today because, honestly, we've got some absolutely fascinating ground to cover. We're going to be connecting the massive macroeconomic dots of 2026 directly to the very micro realities of our personal bank accounts. You know, we hear about the Fed, inflation, and interest rates literally all the time. But today we're translating all of that data into actual dollars and cents.
Okay, let's dive into this. How exactly is the 2026 economy quietly, yet pretty dramatically, reshaping your wallet? It's so easy to let terms like benchmark rates or consumer price index just kind of wash over us as abstract financial jargon. But the reality is, these massive economic levers dictate the exact terms of our mortgages, the returns on our savings accounts, and yep, even the fees we're paying at the bank. So today, we're taking a really structured look at exactly how this whole thing works. Here is our roadmap for today. First, the inflation domino effect. Then, maximizing your cash savings. Third, decoding home affordability. And finally, slashing bank overdraft fees.
Section 1. The inflation domino effect. Tracking the macro spark. To truly grasp what's happening inside our wallets, we first have to look at the broader U.S. economy. And that brings us to our first major data point, 3.3%. In March 2026, the U.S. annual inflation rate jumped to 3.3%. Just to put that into perspective for a second, it was sitting at 2.4% in January and February. So this recent spike marks the highest level we've seen since May of 2024. It was a sharp increase for sure, but it definitely didn't come out of nowhere.
The data shows us exactly what's driving that 3.3% figure. The surge is primarily being driven by rising energy costs, which are directly linked to the geopolitical realities of the war with Iran. Gasoline prices shot up 18.9%, and fuel oil jumped a massive 44.2%. These energy costs pushed overall inflation up, which entirely offset price declines we saw in other sectors, like used cars and trucks, which actually dropped by 3.2%. We're simply looking at the factual data here. Global events are directly driving up what it costs to fill your tank and heat your home.
And because inflation has proven to be so stubborn, it's really forced the hand of the Federal Reserve. Taking a look at the Fed's benchmark rate over the last couple of years, you'll notice how we saw rate cuts in late 2025. But because of that recent inflation data we just looked at, the Fed has been forced to hold rates steady. As of April 2026, they've paused at a target range of 3.50% to 3.75%. So, those rate cuts have completely halted for now.
Section 2. Maximizing your cash savings. The silver lining of high rates.
So the crucial point is that these elevated Fed rates aren't just bad news. They actually create some absolutely incredible opportunities for savers if you know where to look. Just check out this staggering contrast. On one side, the national average savings rate sits at a meager 0.38%. But on the other side, the top high-yield savings account is currently yielding 4.21%. That is more than 10 times the national average. If your emergency fund is just sitting in a traditional brick-and-mortar bank right now, you're quite literally leaving free money on the table every single month.
Let's break down the top banks for May 2026. Axos Bank is leading the pack at 4.21%, followed closely by SoFi and Lending Club at up to 4.00%. But listen, you absolutely have to read the fine print. To actually get that 4.21% at Axos, you need a $1,500 monthly direct deposit. Lending Club, they require you to deposit $250 a month to get their top rate. The highest yields usually demand consistent financial behavior. It's an amazing deal, but really, only if it fits your existing banking habits.
Let's do the real-world math on this, because this is where it gets fun. If you take a $10,000 deposit and just leave it for 1 year at Axos Bank's 4.21% rate, you will earn $421. If you leave that exact same $10,000 at the national average of 0.38%, you earn just $38. And if you leave it in a typical big bank earning 0.01%, you make a measly $1 for the entire year. $1! The difference is absolutely massive for your financial momentum.
Now, a super common question I get is, are these online banks actually safe? The answer is yes, absolutely. Whether you're using an online-only bank or a traditional credit union, you just want to look for FDIC or NCUA insurance. This provides federal protection covering your deposits up to $250,000 per depositor per institution. That means your principal has zero market risk. You can chase those high yields with total peace of mind.
Section 3. Decoding home affordability. Buying in a 7% mortgage market.
We just talked about the silver lining of high rates, but now we have to acknowledge the other side of the coin, the pain of borrowing, particularly with 30-year mortgages hovering near 7%. And this brilliantly illustrates the challenge, the 28-36 budgeting rule. Financial experts generally agree your housing expenses should take up no more than 28% of your gross monthly income. Total debt, so housing plus student loans, car payments, credit cards, should be no more than 36%. That leaves 64% for, well, life, groceries, and savings. In a 7% mortgage environment, keeping your housing slice to just 28% is incredibly challenging.
To see how these macro interest rates hit our micro monthly budgets, let's ask a very practical question. How much does a 1% rate hike actually cost you? Imagine you're buying a $600,000 home and you've managed to put 20% down.
Here's how the math shakes out. If you had secured a 6% mortgage rate, your principal and interest payment would be $2,878. But at a 7% rate, that exact same house with the exact same down payment costs $3,193 a month. That is an extra $315 every single month, strictly going toward interest. Over the course of a year, that's nearly $3,800. This perfectly demonstrates why affordability is just so stretched for buyers right now.
If hitting a 20% down payment feels completely impossible in this economy, there are actionable solutions. Government-backed alternatives are absolutely vital right now. FHA loans allow buyers with credit scores of 580 or higher to put down as little as 3.5%. And if you're an eligible service member or veteran, VA loans offer incredible terms, requiring absolutely 0% down and no private mortgage insurance. The point is, you have options to get your foot in the door.
Section 4. Slashing bank overdraft fees. Regulatory relief on the horizon. Protecting your wallet isn't just about managing mortgage debt or earning yields. It's also about avoiding punishing penalties. Now, what's really interesting about this slide is the sheer scale of the change coming our way. Currently, the average overdraft fee in the U.S. is $27.08, which costs Americans billions of dollars a year. But the Consumer Financial Protection Bureau, the CFPB, has announced some massive relief. Starting in October 2025, large banks will be capped at charging a maximum of just $5 for an overdraft.
The mechanics of how the CFPB is actually doing this are pretty fascinating. They're closing a legal loophole that has existed since 1968. For decades, banks treated overdrafts as this sort of unregulated profit center. The new rule forces large banks, meaning those with over $10 billion in assets, to treat overdraft lines of credit like regulated loans under the Truth in Lending Act. That means they finally have to clearly disclose interest rates and the true cost of borrowing to the consumer. But here's the catch, right? October 2025 is still a ways off. You need to take steps to protect your cash today. So here are 4 actionable things you can do immediately. First, simply switch to a bank that has already eliminated overdraft fees. They definitely exist. Second, utilize early direct deposit features so your paycheck hits your account a few days faster. Third, budget strategically to really map out your cash flow. And finally, go into your banking app right now and set up a push notification for when your balance drops below a certain amount. Super easy, and it works.
As we wrap up this explainer, I want to leave you with a question to provoke a little bit of action. Is your money working for you or against you? We've seen how inflation is pushing costs up, but we've also seen how a quick bank switch could literally earn you hundreds of dollars in interest, and how a simple app alert can save you from a $27 penalty. Look, the macroeconomy might be totally out of our control, but the micro-reality of your bank account is entirely up to you. I challenge you to review your savings yields and bank fees today. Thanks so much for joining me, and keep learning.